Hello everyone, welcome to this lesson where we're going to look at another indicator. This time we are looking at what is called stochastic. So I'm going to just search here for stock. So there we have the stochastic. I'm going to just zoom it in so that is the only thing that is appearing. So here on our stochastic we have got what is called a percentage K, which is in this case the blue line. Then we have what is called the percentage D, which is the red line. The percentage D or the red line is also called the signal line, like we had with the MACD as well. Now the stochastic uses a number of periods that is usually called the look back period. In this case, the look back period is 14 days. Then the amount or default value that is used to calculate the percentage D is 3, which we have in this case. These ones can be changed, but usually you need to get to understand the hang of it. And once you do, then you can play around with it, maybe to change the values to smoothen out the movements. Usually there is what is called the fast and the slow stochastic. As you learn more, you would get to understand how you can put this on a chart to influence how the blue line moves in terms of smoothing it out so that there are no zigzags as much as you see currently. Now, how do you use the stochastic indicator? It has got two sections. As you can see, there's a purple middle section, then the upper section and the lower section. Usually, stochastic is great for pointing what is called overbought scenarios. So if the line crosses above this purple area, then we tend to say the share or the asset is overbought. And when the lines move below the purple section, then we say the share or the asset has been oversold. The values that are set for oversold and overbought is 20 and 80. So above 80 is overbought, below 20 is oversold. So in your trading strategy, you might also want to look at each trade and say, before I enter, can I look at the stochastic? What is it telling me? Where is the price currently, or where is the trend? Is it safe for me to enter when it's overbought? Or it's safer for me to enter long when it's oversold? So you want to buy low and sell high if you're going long. Then if you're shorting, then you want to look for signs that there is an overbought scenario and you want to go in and short that share. When it moves to oversold, then you buy back after a profit, and if you want, you can go long, which I usually call riding waves, whereby you sell at this point or you buy maybe at this point. Then you hold on and ride the wave. When it reaches this level, when it's coming down, then you slide with it. It comes back up again and you slide with it going down again. So these are ways that you can look at and design into your trading strategy so that you can be able to make more or a bit of profit in the market. So this is how the stochastics look like. So I'm going to just bring the chart in this case here. So remember we said above here it's overbought. So as you can see, when price moves to this level, then the trend sort of starts coming downwards. Then it turns up again and it comes down. So here you can see from this point here, we can see that this point was the point where the market reached the top. Then here there was a cross. So like the moving average convergence divergence, we also have a cross. So when we have got the K line crossing the D line or the K line crossing the signal line, then we can know that it's about to turn bearish. When the K line crosses back above the signal line, then we say it's about to go bullish. But as you can see, it's not always the case, as here it turned back downwards before trying to go up again, and it was failing until that point. So sometimes you might see things moving in this way upwards. Don't always think that from here to there it means price rallied. Sometimes it was just chopping up and down, pulling the stochastic upwards as well. So you always need to look at many indicators for confirmation if you are using that as a strategy. However, usually if you are using the MACD, you might not want to use the stochastic, or if you are using the stochastic, you might not want to use the MACD because we call them both oscillators, so you always want to have one that you use. Rarely do you use two or three because they are really telling you more like the same information. So that's all for now. We'll look at more features as we dig deep into the charts.